All right, welcome to the deep dive. Today we are really digging into a big one you sent over.
A really big one. This call was something else.
We're talking about Micron Technology, their fiscal Q1 2026 earnings call, which was held right after the market closed on December 17th.
And, this wasn't just another earnings report. This is a definitive statement, I think, about the structural shift that AI is driving.
Right. So the headline beat was strong, obviously, but the real story was the guidance.
Oh, the guidance was the market mover. It basically forced an immediate re-rating of the stock. It was incredible to watch.
Okay, so let's jump right into the numbers that caused that initial aftershock. Let's give everyone the high-level snapshot for FQ1.
They absolutely crushed it.
So non-GAAP EPS, it came in at $4.78.
Which was way above the $3.96 consensus. I mean, an 82.6 beat. That's huge.
And on the top line, revenue hit $13.64 billion.
Beating the consensus of $12.91 billion by, almost $750 million?
And to put that into perspective, that revenue figure is about 56.6% growth year over year.
Which is just staggering.
Yeah.
And what's fascinating is the stock was actually down like 3% heading into the print. The sentiment was lukewarm at best.
And then it just exploded.
Jumped over 8% after hours. It just shows that the market finally got the message that this isn't a normal memory cycle. This one is different.
It's structural.
It's structurally driven by AI. Exactly.
Okay, so let's get into the mechanics of how they did that, because it points to, like you said, a fundamental strength, not just a one-off thing.
Right.
Management was very clear. Total company revenue, DRAM, NAND, HBM,
with memory,
and data center revenue. All of them hit new records.
Every single one. And that kind of performance across the board is directly tied to pricing power. It's about scarcity and having the right product mix.
And that's where the financial health story gets really compelling, right? The margins?
The margins were eye-popping. Non-GAAP gross margin hit 56.8%.
56.8%. That's up 11 percentage points just from the prior quarter.
In the memory industry. That kind of expansion is, it's almost historic. It just doesn't happen.
So that margin flows right down to the cash.
Straight to the balance sheet.
Yeah.
Operating cash flow was $8.41 billion. That led to a record adjusted free cash flow of $3.9 billion.
And when you see cash like that, you know the pricing environment is strong.
Oh, yeah. They're commanding price. DRAM prices were up about 20% sequentially, and NAND was up in the mid-teens. That's the ultimate signal of a supply crunch.
Okay, so let's break down where that FQ1 revenue came from by the business unit, because it really tells the story.
It really does.
Cloud memory was the biggest piece of the pie, over $5.2 billion.
Which is 39% of their total revenue, all AI infrastructure.
Then you have mobile and client at $4.2 billion, or 31%.
And core data center was another $2.3 billion, 17%.
And the smallest was automotive and embedded at 13%. So the mix just screams, we are all in on the AI data center.
It's a total pivot.
So if FQ1 was strong, the FQ2 guidance was the earthquake. This is what triggered that whole re-rating you mentioned.
This is the key piece of news. This signals a massive step function change in performance.
All right, lay it on us. FQ2 2026 guidance.
Revenue midpoint, $18.70 billion.
$18.7 billion. That's up from $13.6.
A huge jump. Then non-GAAP EPS midpoint, a record $8.42. But the number that just stunned everyone into silence.
The gross margin?
The non-GAAP gross margin guidance midpoint, 68%.
68%.
Yeah.
How is that even possible in this sector? What could go wrong there? A yield issue on HBM?
That's the question everyone had, and management's answer was just pure confidence. They said it implies substantial new records and that the business will just keep getting stronger all through fiscal 2026.
And the reason is AI.
The reason is AI-driven demand and, crucially, very, very tight supply. And they said they expect these conditions to last not just through 2026, but beyond calendar 2026.
So they see this as a multi-year structural shift.
Exactly. Not a quick cycle. It's a new paradigm where they just have incredible pricing leverage.
And they back that up with some pretty specific customer commitments, especially for HBM, right?
Yeah, this is the absolute core of it. HBM is the bottleneck for the entire AI supply chain, and Micron is just capitalizing completely.
So what do they say specifically?
They've completed price and volume agreements for their entire calendar 2026 supply of HBM.
The entire year sold out.
Sold out.
Yeah.
Including the next-gen HBM4. They have nothing left to sell for 2026.
Wow.
And then they accelerated their forecast for the HBM market, the TAM. They're now projecting it'll hit $100 billion by 2028.
$100 billion. They pulled that forecast in by 2 full years.
2 years. That HBM market is now projected to be bigger than the entire traditional DRAM market was in 2024.
That's an insane growth rate.
It is. And remember that 3-to-1 trade ratio. For every 1 unit of HBM you make, you use up the wafer capacity of roughly 3 units of normal DDR5.
So every HBM chip they sell actually makes the supply crunch in the normal memory market even worse.
Exactly. It pushes prices up everywhere. It's a virtuous cycle for them.
Okay, so the numbers are historic. Let's talk about the strategy. How are they turning this crunch into, long-term security for the business?
Well, the biggest pivot, and it's directly tied to those insane margins, is that they're getting out of the consumer business.
They're exiting the crucial brand.
Yeah. Shipments will run through FQ2, and then that's it.
Yeah.
They're deliberately walking away from selling memory sticks to gamers and PC builders.
Why? Why give up that revenue?
Because it's volatile, it's low margin, and most importantly, they need that physical supply. They have to reallocate every wafer they can to the high-value enterprise and data center customers who are begging for it.
It's a business model pivot.
From a commodity player to an infrastructure utility. It's about structural profitability, not just market share.
And they're locking that in with new contracts, right? These multi-year LTAs.
That's right. They're moving to long-term agreements with stronger commitments. These aren't just one-year deals anymore. We're talking multi-year, often non-cancelable take-or-pay contracts.
So customers are giving up flexibility just to guarantee they get chips.
They have to. It de-risks Micron's CapEx plans, and it guarantees allocation for the hyperscalers. It's a fundamental shift in the buyer-seller relationship.
Speaking of CapEx, that brings up the cost. They announced they're raising their fiscal 2026 CapEx to around $20 billion.
Up from a prior estimate of $18 billion.
So $2 billion more. Isn't there a risk that by spending that much, they just build too much capacity and kill the margins?
That's always the fear in memory. But based on what they said, no. They were explicit. They said they are currently unable to meet between 50% and 2/3 of the demand from several of their key customers.
They're turning away business.
Core customers.
Yeah.
They literally can't make enough. So the CapEx isn't speculative, it's defensive. It's to try and catch up to the demand that's already there.
And that $20 billion is a massive barrier to entry.
A huge one. It forces competitors to make a really tough choice between their own profitability and trying to keep up. And most of that money is going to HBM capability and their next-gen 1-gamma DRAM node.
Right, the 1-gamma node. Let's just quickly explain why that's so important.
It's all about efficiency. The 1-gamma node gives you better density, better power efficiency, and a lower cost per bit. You absolutely need that technological edge to make the economics of HBM work with its advanced packaging costs.
We also saw them pull in their U.S. manufacturing plans, the Idaho FAB.
Yeah, that timeline got accelerated. They're now expecting the first wafers out of that facility in mid-calendar 2027. They are racing to build capacity.
Okay, fantastic breakdown. Before we wrap, it's time for our favorite segment. This is not financial advice.
And I have to say it, standard disclaimer applies. This is for entertainment, for discussion. We are not financial advisors. Please do not act on this.
Okay, with that very clear warning, given everything we've talked about, the scarcity, the CapEx, the TAM, what's the outrageous but plausible trade idea you took from this call?
So I'm calling this one a capacity-constrained arbitrage trade.
Okay.
The idea is built on the fact that Micron is sold out for 2026. They have essentially a temporary supply monopoly in the premium AI memory market.
So how would you structure a trade around that?
The idea would be to initiate a long-term position in Micron, financed by shorting a non-AI linked high-volume memory competitor.
So who would you short? What's the profile?
You'd look for a company whose margins are going to get crushed, someone who lacks the proprietary advanced packaging for HBM, and whose revenue is still way too reliant on those price-sensitive consumer segments. The exact business Micron is now abandoning.
I see. So the thesis is that the players who can't spend that $20 billion on CapEx are just going to get left behind.
Exactly. They'll be relegated to a structurally lower margin business while Micron captures the AI premium. The barrier to entry is now measured in tens of billions of dollars.
That really captures the whole structural shift. Okay, to summarize this deep dive for you, we saw a record quarter.
Record revenue, record free cash flow, and especially record gross margin.
Then we got a record forward guide for FQ2 with that unbelievable 68% gross margin target.
HBM is now confirmed as the key differentiator. They're sold out for 2026, and the market is rocketing toward $100 billion by 2028.
And finally, that massive $20 billion CapEx commitment signals their confidence and their intent to dominate this market for years to come.
And management said something really provocative. They said AI memory is moving from being just a system component to being a strategic asset. And that brings up a final thought for you, the listener, to mull over.
Go on.
If customers are signing these multi-year take-or-pay contracts just to guarantee they get chips, how much pricing power will these memory manufacturers ultimately have? If customers are basically forced to invest in their suppliers' capacity to secure their own future, it suggests that companies like Micron might start to capture value that was historically only held by the AI chip designers themselves. Something to think about.
Indeed. Thank you for joining us for this deep dive. We'll catch you on the next one.